Welcome to Vice Capital. Today I want to talk about the biggest mistakes I made when I started dividend investing. When I first discovered dividends, I saw them as one of the purest forms of passive income. The idea was simple. Buy quality companies, let them pay you cash, and over time, those dividend checks grow. For me, that was extremely attractive. I wanted passive income. I wanted money coming in without having to sell shares. And I believed that if I picked strong companies, strong sectors, and built the portfolio correctly, dividend investing could become a real path to financial freedom. But when I started, I made a lot of mistakes. And today, I want to share them, because these are the mistakes that can destroy your returns, complicate your portfolio, and make dividend investing much harder than it needs to be. Mistake number 1. Over-diversifying too much. When I started dividend investing, all I cared about was diversification. I thought the more companies I owned, the safer I was. So I started putting small amounts of money into a lot of different stocks. At one point, my portfolio had around 60 different companies. At first, that felt professional. It felt diversified. It felt responsible. It felt like I was reducing risk. But in reality, it became a problem. Instead of buying high-quality companies at the right price, I had my money spread across too many names. That meant I was receiving very small dividend payments from each company, and the portfolio became unnecessarily complicated. It also became a nightmare from a tax perspective. When you own too many small positions across different countries, tax reporting becomes much more painful than it needs to be. But the biggest issue was opportunity cost. Because my money was spread across too many average positions, I missed better opportunities. There were companies I would love to buy today at the prices I saw back then, but I missed them because I was putting small amounts everywhere instead of concentrating on my best ideas. The lesson: diversification is important, but over-diversification can dilute your best opportunities. You do not need to own every dividend stock. You need to own the right dividend stocks. Mistake number 2. Not understanding double taxation. When I started, I wanted geographic diversification. I liked the idea of owning dividend companies from many different countries. But I did not fully understand that dividend taxes can change your real return dramatically. For example, I invested in French companies, and France withheld tax on the dividend. Then, in my own country, I was taxed again. In some cases, I could recover part of that withholding tax, but not all of it. So the dividend yield I saw on the screen was not the dividend yield I actually received. That was a major lesson. Not all countries are equally favorable for dividend investors. Highly efficient. The United States can be very attractive if the correct tax forms are filed because the withholding tax can be reduced. The UK and Singapore are also very favorable because they generally have 0% withholding tax on dividends for foreign investors. Acceptable. The Netherlands normally withholds around 15%, and Canada can also be attractive if your broker applies the correct treaty forms. Inefficient. Some countries become very inefficient if the withholding tax is high or if your broker does not handle the paperwork properly. The lesson: dividend investing is not only about the gross yield. A 6% yield in one country can be better than an 8% yield in another country if the tax treatment is cleaner. Always look at the net dividend. Mistake number 3. Buying cyclical stocks without understanding the cycle. When I started dividend investing, I looked at sectors like oil, mining, and shipping, and I thought, these dividends are incredible. The cash flow is huge. The yields are high. This looks perfect for passive income. But that was a very dangerous way to look at it because many of these businesses are highly cyclical. A company in oil, mining, or shipping can look extremely cheap when the cycle is strong. Earnings are high, cash flow is high, dividends look massive, and the stock may look undervalued on paper. But very often, that is exactly when the risk is highest. For example, I started buying companies like Petrobras, mining companies, and container shipping stocks. At the time, they looked attractive because the dividends were huge and the businesses were generating a lot of cash. But I was not asking the most important question: are these earnings normal, or are they peak cycle earnings? And that was the mistake. I was buying when profits were inflated, when the dividend looked safe, and when market conditions were already very strong. Then the cycle turned. Commodity prices weakened, shipping rates normalized, sentiment changed, and the stock price fell by almost 30%. Suddenly, what I thought was safe dividend income became a capital loss. The lesson: A high dividend from a cyclical company is not the same as a safe dividend. With cyclical stocks, timing matters much more. You need to understand where the company is in the cycle, whether the earnings are sustainable, and whether the dividend can survive when conditions get worse. Mistake number 4. Overthinking obvious opportunities. Another mistake I made was not buying when I saw the right opportunity. There were moments when high-quality dividend companies, especially utilities, REITs, and long-term dividend payers, traded at prices that were clearly attractive. But instead of acting, I kept thinking. I kept waiting. I kept trying to find the perfect entry point. The problem is that great dividend companies do not give you perfect opportunities every week. Sometimes they dip, the valuation becomes attractive, and the dividend yield becomes compelling. But that window does not stay open for long. I missed companies that I would love to buy today at those old prices, not because I did not understand the business, but because I hesitated too much. Mistake number 5. Using the wrong payout ratio. Another big mistake I made was not understanding that every type of dividend company has its own correct payout metric. When I started buying real estate investment trusts, REITs, I looked at the payout ratios shown on basic financial websites, and sometimes they looked extremely high or even unsustainable. But I did not understand that for REITs, the normal earnings payout ratio is often misleading. For REITs, you normally need to look at funds from operations, FFO, and preferably adjusted funds from operations, AFFO. That is much more relevant because real estate companies have large depreciation expenses that reduce accounting earnings but do not reflect the real cash flow available to pay dividends. The same applies to other complex businesses. For example, some insurers under accounting standards like IFRS 17 can show strange payout ratios based on reported earnings. A company like Legal & General may look scary if you only look at a basic payout ratio on a finance website, but that does not chess match the full dividend picture. The lesson: never judge every dividend stock with the same payout ratio metric. Mistake number 6. Confusing essential demand with safe dividends. My final mistake was confusing essential demand with safe dividends. When I started building my dividend portfolio, I wanted to own companies that would still be relevant in the future and could survive recessions. So I looked at healthcare, pharmaceutical companies, and telecoms. At first, the logic seemed obvious. Everybody needs medicine, everybody needs healthcare, and people will continue paying their phone bills. But that view was too simplistic. Pharmaceuticals, demand can be stable, but individual companies face major patent expiration risks. A drug can generate billions in revenue for years, but once the patent expires, competition arrives, pricing power falls, and the company can lose a major part of its earnings base, putting the dividend under pressure. Telecoms. I thought telecom companies were forever businesses because people need mobile data and internet. But many telecom companies are highly leveraged, require huge capital expenditures, CapEx, to maintain networks, and face intense competition and regulation. I learned this the hard way with Bell Canada's dividend cut. The lesson: an essential service does not automatically mean a safe dividend. The real question is, will this company generate enough free cash flow, after debt, CapEx, competition, and reinvestment needs, to keep paying and growing the dividend? That is the difference between a good story and a good investment. In conclusion, to summarize, these were my biggest dividend investing mistakes: over-diversification, ending up with too many small, complicated positions; ignoring double taxation, focusing on gross yield instead of net income; chasing cyclical yields, buying at the peak of a sector's cycle; hesitating on value, overthinking great opportunities and missing attractive entry points; using the wrong metrics, applying the same basic payout ratio to entirely different sectors; confusing demand with cash flow, assuming essential services equal safe dividends. Dividend investing works, but it only works if you treat it like business ownership, not yield chasing. You need quality, valuation discipline, tax awareness, sector-specific metrics, and above all, an understanding of the business behind the dividend. The goal is not just to receive dividends today. The goal is to build a portfolio that can keep paying you for decades. That is the real game. If you enjoyed this analysis, subscribe to Vice Capital for more deep dives into high-quality dividend stocks, and I'll see you in the next one.